Well, good evening, everyone. Welcome back to the channel. So, with 2024 fast approaching, we're actually only like 26 days away from a new year. So, I wanted to actually go over all of the tax advantaged account limits for 2024. So, let's do that. And this required some really intense cutting edge research on my part, such as a 2-second Google search. And I already knew about this, but I've been wanting to do a video for some time. So actually, between the three main tax advantaged accounts, the 401k limit is going up to 23,000, up from 22,500. The limit on IRA contributions like Roth is going up from 6,500 to 7,000. So that's really tremendous news. We actually haven't seen increases in the Roth like we're seeing the past 2 years, but we're seeing that now. So that's really good. That's one of the, I guess, few silver linings of the inflationary situation that we have. So, all in all, if we add up these three or these two, so it's 30,000 between the Roth IRA and the 401k. But if we look at the HSA account for individuals also increased, and I'll go over the numbers for married couples as well. So you can fund not all of you may know this, but you can actually fund an HSA account as an individual and as a married couple. You can fund it and treat it just like a standard retirement account as long as the money is used on medical expenses before the age of 65, I believe. You don't get any tax penalty, but after the age of or it might be 62, I can't remember. But after a certain age, there's like no tax penalty on the money and what it grew to. So it's almost like another IRA. So for married couples, it's 8,300. For individuals, it's 4,150. These amounts are about a 7% increase over what you can contribute for 2023. So that's actually tremendous news for us. So, and then if you're 55 and older, this is something that comes into play with the Roth IRA too. When you're 55 and older, you can make what they call catch up contributions. So that helps you to catch up from, say, you weren't contributing to an account when you were like 18, you might not have had any money until you were like, say, in your mid 20s. So, you can catch up when you get into your 50s for those early years because you're eligible at age 18 to contribute up to the taxable maximum. But I would think very few people are able to do that when they're like 18 or 19 years old or even early 20s. But anyway, all in all, you can contribute a total of $34,150 as an individual. And as married couples, you can actually contribute more. And we're going to go into how these will all really help us to accelerate our dividend growth. So, all right, with that, now let's see here. Okay, we want to look at, so income limits are less than 153,000 for single tax filers and less than 228,000 for those married filing jointly. And here's some other nuggets of information here. And of course, you can always go to the IRS's official website to see this stuff. But by the way, for the 401k, which functions as a traditional IRA, for married couples, it's more, I believe. Or if you're over 50, if you're over the age of 50, I believe. Let's see, 401k. Let's see. Okay, there are income limits for this, but if you're over age 50, 23,000. Oh, combined. So wow, your company can match up to this minus 23,000. Interesting. If you're age 50 or older, you're eligible for an additional 7,500 in catch-up contributions, raising your employee contribution limit to 30,500. That's incredible. So, oh, we got a good morning from Hog Farmer, even though it's not morning, at least where I am. Maybe it's morning where you are, but let's see. Okay, so now to get to the meat of the video, how will this accelerate our dividend gains? Now, for a lot of us in our employer-sponsored 401ks, um, we're not actually able to contribute to things like yield max and whatnot. So traditionally, we have to do like a fund of funds. So we'll have to pick something else like In my Fidelity HSA, I pick, fund of funds. So I'll give some good examples like this FISROX. This is like a zero cost total market index fund. So typically the 401ks are in stuff like this. So this fund, from 2018 to now, this has actually done a 60% rate of return. And from 2020 onward, it has doubled, actually more than doubled. But traditionally in the 401ks, you're going to actually be in like fund of funds. But if you are able to do, say, yield max, just think about, compounding returns and whatnot. Think about how well, that will do when you're reinvesting the dividends. So let's see here. Excuse me. Pulling up a Google sheet here. Okay, so we're still on the FISROX Fidelity Zero. And I know these probably don't excite most of you because I only see 6 of you on. So we're going to do some spreadsheet stuff here real quick. But if you'll just bear with me, I will be right back in like 10 seconds. Okay, sorry about that, everyone. So to give you an idea of some, fund of funds, I'll just go over like some of the Fidelity ones because, like I've said before, each company has their own fund of funds. Each company has like their own S&P fund, their own Nasdaq fund. Um, so we'll look at like uh, we could just look at the Qs, for the Nasdaq. So in a typical 401k, like in mine, I have exposure to the Nasdaq, exposure to the Russell, exposure to the S&P. So I have like broad-based market ETFs. So the funny thing, as much as we talk about yield max on here, regardless of how poorly yield max does, I'm actually protected against that because I've only put a relatively speaking of the overall investable portfolio, I've only put like, not even 10% into that. So it wouldn't kill me to lose all of that. So anyway, so here's the QQQ. This is an idea of like a NASDAQ fund. Well, this isn't the NASDAQ fund, but when you're in your 401k, typically your employer constrains you to funds like these. So you can see this one has done pretty well year to date. We're up from 268 all the way to almost 388. So that's really tremendous. That's actually a 45% rate of return. So it seems like it's almost outpacing the actual NASDAQ itself. Let's see for the NASDAQ for the year to date, percentage wise, how we're doing. And of course, stupid Yahoo is going to give us just the futures, which we're not really too interested in. So wow, the Nasdaq has gained almost 6,000 points this year, from 11,013 to 15,968. And I'll get that percentage here in a second. That is, oh, it pretty much is on par with the TQQ, excuse me, the QQQ. Now, if some of you are looking for more accelerated returns, there's the triple Qs, of course, for the NASDAQ. And your employer probably wouldn't let you do this, but if you have a more customizable 401k outside of an employer, the triple Qs has obviously done triple times what the NASDAQ has done. And so when you start getting into trading options and whatnot on those, it obviously is tremendous as far as accelerating your returns. Oh, how about that? I started a video, lost a subscriber. Amazing. This YouTube stuff is a tough business, I have to say. I really feel like I've been giving it my all the last couple of weeks. Anyway, so let's look at dividends because I know that's what we really are all here to talk about. So just say you're able to put stuff in the TSLY or any yield max fund. By the way, the TSLY was up to 1173 today. Let me see here. I'm going to start a Google sheet on here. Oh, here's my last stuff here. I actually can go over, this is an old example. but you guys will get the idea because I do these examples a lot. This is going to be on the JEPQ back when we were back at least when I was in that one. Okay, so let me share the screen again here. So if you were to take your whole 401k and max it out and put into dividend funds, we'll just start with the JEPQ example that I have in the spreadsheet here. So in this one, obviously, you know how the compound growth rate of return works. If you're reinvesting on a compounded annual basis, you're going to end up with like a 9x at the end of like 10 years or so. And also, the main thing I want to cover, just a 10-year 401k scenario. Now, here's where things get really exciting because say that the market can get back to where it was before. So take, for example, the NASDAQ. The NASDAQ has done over 35%, which I included in the first year here. Now, here's where things get really interesting because 22,500, I'm going to update this now, but 22,500 was the maximum amount you could contribute to a 401k in 2023 if you're under 50. Now, it's going up to 23,000, so I'm gonna type in 23,000 now. Now watch what this does for a compounded return. You see how putting 23,000, that just made us so much more money on the end of it here. And now look at this. The difference between 500 bucks a year is almost 38, or excuse me, almost $18,000 at the end of year 10. And that's assuming, I know this seems unrealistic, but assuming like 35% rate of return here, 25%, 25, just assuming we could get to somewhere like we were at for, 12 years in a row with the bull market that we had. Um, so really, this is what I wanted to cover. And you can take yield max or whatever dividend fund is your favorite and factor this into the calculation. But obviously, when you're able to contribute up to the maximum in the 401k over 10 years, it's not totally out of the question, especially with company matching and whatnot. It's not totally out of the question to have $1 million 401k at the end of 10 years. So anyway, hopefully that gives you all some ideas there. Hopefully that sparks some innovation in terms of your investment ideas. So, like, comment, and subscribe if you all haven't already. And thank you all for tuning in for the few of you that did. And I will get back to our regularly scheduled dividend programming hopefully tomorrow. Thank you all. Take care. Have a great evening.